first thing to note when making a journal entry like this is that we are paying off the full liability. So no matter how much actual cash goes out, the main thing of note is that everything that we owed to a supplier is paid off. So we had a credit of $3,000 when we made this purchase, and now we debit that same account for $3,000 to completely eliminate the liability. Then we have cash, and you'll note that I've left a line up there, and there's a good reason for that, which we'll see later. Right now, our concern is to figure out how much cash we actually paid. So we owed $3,000, and we paid on May 16th. Our order was on May 1st. So the discount term that were offered to us were 2/15. So that's May 16th date is within the 15 days of the discount period, because you start counting from May 2nd, and from 2nd to 16th is less than 15 days. So we qualify for that 2% discount. That will give us a discount of $60. So the net cash that we pay is actually 3,000 minus 60. So we will pay $2,940 to our supplier. The remaining $60, it will be a credit because we have to have our debits equal to credits. So 3,000 here, and this gives us 3,000 here. It will be inventory. And I'll explain why it's inventory. The reasoning is that based on historical cost, we should record our inventory at what we paid for it. So back when we first acquired the inventory, we owed $3,000 to our supplier, and that's what we recorded our inventory as. However, when we actually made the payment with cash, we paid $60 less. So that $60 credit is basically us taking a small portion of inventory out, a small value out of our asset base, because we didn't actually pay 3,000, we actually paid 29.40. So by crediting $60, we bring our inventory value down, and we follow the historical cost principle. So let's go ahead and finish off our journal entry by writing a brief description. Paid off May 1st, account payable within the discount. I'm going to go ahead and write a quick calculation just so in future people can see where that number came from. $3,000 times 2%. Okay, so that looks good. Let's make some conclusions about this journal entry. First, the full AP amount owed for the inventory purchase is debited to wipe out the liability. Recall that the bookkeeper owed $3,000 to his supplier, for the May 1st order, we need to debit account payable for the same amount once cash is paid to the supplier, even though less cash is paid than originally invoiced. The first credit entry is for cash paid to the supplier. After the bookstore pays the supplier for the goods, taking advantage of the discount, we credit the cash account for the amount paid. In this case, it is $29.40, which is $3,000 minus $60. So just a quick note here, our first credit entry was actually lower on the line paper because I decided to leave a blank line in the middle as opposed to writing down inventory at the very bottom. It's really your choice how you want to order your debit or your credit. Typically, the neater way to do it is to kind of keep the debits together at the top and keep the credits together at the bottom. So in some instances, you might have an entry where you're not sure if you're going to end up with a debit or credit at the end. So that's why I tend to leave blank lines in the middle as I'm going through the process of first writing down my debits and then my credits. So in this case, first I wrote down account payable as a debit, and I wrote down my cash as a credit, as I knew it was for sure going to be a credit. And then I saw what was left over, which made sense, $60 coming out of inventory. The second credit entry is to recognize the discount's impact on inventory. As a result of our discount, our inventory is now worth slightly less than before. So item must be shown on the books at historical cost, as we talked about. Therefore, the inventory account is credited for the amount of the discount. This final piece results in our entry being balanced, debit equal credit. Now, let's assume that the bookstore decided not to pay early. The payment on May 31st will be journalized as. So why don't you just take a minute here and try this journal entry, and we will continue in this same video. So this will be a journal entry, which is pretty straightforward. Once again, we will debit account payable for the full amount, as we no longer owe our supplier this money, but we only have one credit account in this journal entry, which will be cash, as we will pay the full amount, and I'll write down a brief description. Payment made for May 1st order. Okay, now we're going to jump into purchase returns and allowances. The first journal entry here is going to be a return of merchandise from the bookstore back to its supplier on May 21st. So I'm not going to cover this entry in this video, so you get a chance to try it before you watch the next video. The only thing missing here is the dollar amount, And I'll tell you the dollar amount we will be including in the journal entry will be $500. Now the second journal entry is a little bit more interesting. This is where the bookstore received a damaged product, and instead of returning it, they accepted a discount from the supplier. So think about that, how you would journalize that, and we will go over both of these journal entries in the next video.